Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in. Thanks very much for listening. We're on this as well as several other radio stations on Saturday and Sunday across the dial in Vegas as well as California and now down in Albuquerque, New Mexico. You know, Daryl, I talked to a couple of real estate agents down in Albuquerque, so we will soon to have a number of experts in the New Mexico market as well as Albuquerque to tell us what's going on in the market. Because as you know, real estate is really different everywhere. And if you have a local presence, it really helps the people there decide, you know, what's happening in real estate. Loans per se are everywhere, right? I mean, you can have a loan program in Southern California, match the same loan program that's in Stamford, Connecticut. And there's really no difference. But real estate, it's micro real estate. Each neighborhood, each area has a number of different idiosyncrasies that make it particular to that area. So anyway, I wanted to congratulate the people down there in New Mexico for wanting to join the show and alert everybody who's listening from that market that we soon will have more experts from your area. Really appreciate you listening. If you want to see the show each and every week, of course, you can go to a couple of the radio stations, and we're on YouTube. Go to Jeff Barton, the Mortgage Voice. That's our YouTube channel. We're on 8 of the major podcasts, Google and Apple and iHeartRadio, Spreaker, a number of others. And if you want to go to it, I had a friend actually call me the other day and said they heard me on, it was either Spreaker or iHeartRadio. And I really appreciate the listening audience tuning in and giving us some feedback. Okay, so what is happening out there in the real estate world? I wanted to delve into that a little bit. As well as talk to a couple, 3 guests that'll come on the show today about loans, real estate in general. Some of the interesting things about real estate is that the price for real estate that you want to purchase, I know a lot of people are thinking, okay, with 40 plus million people out of work, there has to be a lot of foreclosures. Well, several things that impact real estate have not happened in the down cycle as they have in previous down cycles. If you remember 10 years ago when we were in the Great Recession, as I guess they're calling it now, when people stopped paying their mortgages, it really put all of the real estate that was purchased then and going back several years in a bad way because the prices fell in some markets 75%. If you go to Vegas or some parts of Arizona, certainly in Florida where they ended up plowing some units under, a lot of units under, after they had built them, overbuilt them. That's not happened this time. And the reason it hasn't happened this time is because we have forbearance, and forbearance, of course, is the ability of a borrower, ability of a mortgage holder to declare that they are in forbearance simply because they have either lost their job or they've lost the income in order to pay that mortgage. So there's up to a year now, 6 months to a year, to be able to not pay your mortgage and have it really not affect the real estate market. So therefore, prices have remained very steady. As a matter of fact, and one of the things that I was quoting yesterday on the show, and by the way, that's the Mortgage Minute. We do it on LinkedIn and Facebook on a daily basis. We have noticed, and I'll go to the notes here if you just give me 1 second. Okay, the mortgage rates are steady and low. We have seen an uptick in prices, 0.2% from May till today, which is at the end of June. The annualized rise in real estate prices is slated or set to be about 5.5%. Now that's an amazing accomplishment if that's possible. We have a number of issues obviously facing real estate as well as the mortgage industry as well as the general economy. But currently we have a very strong real estate market. Hopefully this will bode well for moving forward. We've had a reintroduction of cases in some hot spots. And all these buzzwords are not my buzzwords. They're coming from the medical community or from people who watch this sort of thing. In those areas where we were trying to open up and get the economy rolling, and we have now had a setback in several of those areas, Southern California in general, we have seen, I guess, real estate prices still remain steady, but the unsure of coming back, bounce back, V-shaped recovery, all these, as I said, buzzwords that lead you to believe that it was in fast, out fast, and we're going to be right back to where we were, is slowing and slowed. And this may affect demand, it may affect prices, and it's certainly going to affect those people who have mortgages who cannot pay them but are in forbearance. Not today, not by January, but certainly very soon thereafter. January, February, March is when people started going to forbearance. That's when we're going to see the effect of how many people who have lost their jobs, who haven't either gotten their job back, gotten another job, but still have a mortgage and can't pay anymore. What happens then? At the end of July this year, next month, we're going to see renters in that situation whereby renters can't pay their rent. They've lasted out or gone through the month, 2 month, 3 month moratorium. Some states are different. Some legislatures have extended the moratorium on renters. But for those people who can't pay their rent in many states, they're going to get eviction notices. And so what happens to that population? What happens to the people that are trying to get a mortgage right now who have lost their jobs? That's not going to happen. The non-QM market is not around. Anyway, there's so much going on. Suffice it to say, if you're selling right now, it's a great time to sell. Why do I say that? Because there's little on the market, which is why prices have still increased. As I said a couple days ago on the show, the inventory is at its lowest level in 11 years. That's prior to the last Great Recession. 11 years, lowest number of houses on the market. So Malibu Funding, the company I work for, is in 10 different states. And I have colleagues all over, many different social media platforms. So I'm very well aware of what's going on out there in the real estate world, in the real estate market. And we are looking at prices, and we're looking at a good thing right now, that prices are strong. And prices being strong means that the mortgage that you get is still worth the mortgage that you have gotten a year from now. If in fact we have real estate prices fall, is that mortgage still worth it? Well, the key here is the interest rate. The interest rate you have today is so much different than the interest rates you were getting in 2008, when a lot of people just walked away. Even if you find yourself today, in a year from now, underwater a little bit, or somewhat, or 5 or 10%, can you really say you can go out and get a rental property like the property that you're in for the amount of money that you're paying if you're paying 2.5% on a 30-year fixed rate mortgage? Probably not. And the demand, once foreclosures start, if this scenario plays out, what's going to happen to the rents? More people wanting to rent, the rent's going to go up or down? Of course they're going to go up. Everybody knows that. So even this is the other protection for the property that you're in today, and the price is remaining high, because the demand is going to be there for rentals if the foreclosure market continues or begins, which I think it's going to be in January, February, March next year. The question is, of the 4.5 million properties in forbearance, i.e. has stopped paying the mortgage, how many of those are going to go into foreclosure? What's going to happen to the neighborhoods, the prices of and value of real estate in those particular neighborhoods that the forbearance and the foreclosures are happening? This is all to be seen, but for today, the prices in real estate are very good. There's very little on the market. If you can get into a property right now, you are somewhat protected from long-term damage, even if the property goes underwater. Why? Because the rates are so low, it's still going to be cheaper than renting. So this is my opinion. I'm Jeff Barton, your voice in the mortgage industry. Really appreciate you listening to the show today. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for listening to the show and tuning in. We are on each and every week, 5 stations, 3 different states. We're on the 8 Big podcast as well as YouTube. If you want to see the show, me and my guest, go to YouTube, Jeff Barton, the Mortgage Voice. That's our channel. And you can see this as well as hundreds of other shows that we've had over the time we've been on the air, about 6 years. And I really appreciate the audience feedback. It really helps me develop what we're going to talk about. Although with the way the world is today, it's very easy to come up with topics because there's so much about what we're doing or what we're not doing, which affects real estate, which affects mortgages, and people in general in terms of trying to develop a business strategy to get their message out there and to make a living. With us today from PI Media, once again, is Debbie Harris. She hasn't been on the show before, but I'm grateful to have her back. Debbie, how are you?
I'm terrific, Jeff. Thank you so much for having me back again.
Thank you very much. You know, we've been talking to you over the years. You have a terrific experience and expertise in some of the social media, whether it's Facebook or LinkedIn in particular, which is the one you helped me on. In this pandemic and what we're dealing with, most people working from home, how has that changed what you do for your clients? And how does it change the overall communication, if it does, in these two mediums?
Well, first of all, certainly with everybody home, and in many cases people are still home, they've been in front of their computers. I always say I'm in front of my computers now dawn to dusk. And
Right.
So platforms have become even more relevant over the last few months, particularly LinkedIn. I mean, Facebook always has its place for getting the message out, for branding, but for really dialing in to really forming relationships. What I say is taking LinkedIn connections and turning them into clients or customers and actually building a relationship that starts on the platform. We're seeing a tremendous amount of that lately, and I think that will continue.
Reaching clients, reaching these customers, reaching out in particular through the medium is a lot different than a handshake. And I think this is probably something that will continue. What are some of the strategies that you're telling people in order to humanize themselves, either through Zoom or Facebook Live or any number of these one-on-one sort of camera-based communication styles?
Well, the very first thing is if you're taking a relationship, so let's start from the beginning. You have LinkedIn, you're trying to reach other professionals, other business owners, other C-suite people. You want to make sure that your profile is up to date. You want to make sure you look good. You want to make sure you're smiling in the picture, so on. And then you're starting a connection, you're starting a relationship. So what I always say, be transparent, be open, don't sell. This is not about pitch. This is about who you are, and in things as simple as, hi, I'm really starting to use LinkedIn more. I'd love it if we could connect. Then we connect. Hi, I'd love to learn more about your business. I see that you, and a great way to do this is with something you have an affiliation. So I've been teaching people that are in transition with jobs, you know, your college. Use LinkedIn to find those people where you have an affiliation for the same college, the law school, the organization, the charity you work for. So now the goal is to take that relationship and ultimately get to, could we have a 15-minute Zoom? Could we have a 30-minute? And I'm going to tell you something. Use an app like Calendly or Altium. There's a bunch of them. But you want to make sure that you can give somebody a link, because I'm going to tell you the most annoying thing is to go back and forth 50 times how to schedule with somebody. So
no, I agree.
If they say, yeah, I'd love to learn more, say, hey, here's my Calendly link. Would you pick a time that works for you? This will be the easiest thing. Now you take it to a Zoom, and really you want to be authentic. That's the main thing. You want to be authentic with people. You want to ask people how you can help them. You want to learn about them. I mean, this is how we build relationships, like you just said, Jeff, when we walk in, when we introduce ourselves, when we shake someone's hand. Well, now we have to do it a little differently, but it's all about being authentic.
I love that term. It's overused, but it's really rarely used enough, meaning that being authentic, being who you are, showing yourself in the best light by doing that is not easy. And one of the things I wanted to ask you is, for a lot of people, they are camera shy. They are unable to sit and talk. in front of a camera. Now, I know this may be a generational issue in that a lot of kids younger than 40 or 30, it's just different. But for older people like myself to get in front of a camera or they think they look bad is difficult, even though they're still in business. But do you have a recommendation or maybe some ideas by which you can either get over that or something that may help them through that kind of, I guess, nervousness to be talking, especially in a lot of these cameras, you're looking at yourself when you're talking to the other person.
Yeah, and that's a very good point, Jeff. And I have talked to hundreds and hundreds of professionals, lawyers and realtors and all kinds of business people over the last few months. And many have told me who have been working for many years, who have said, I never used Zoom before. And now I love it. So it's a comfort. Like anything, if it's new to you, it's going to take a little bit of time to get used to it. I always say, if you're dressing for a meeting, it's going to make you more comfortable, at least from the waist up. If you dress the same for the digital meeting, us girls are joking that, please don't make the Zoom too early in the morning because I got to get up and put makeup on. But you would do that if you were leaving the house and you were sitting in your car commuting for 45 minutes. So I think it's recognizing that you're going to be a little bit uncomfortable at the beginning if you haven't done it. Please, please, please don't get frustrated by, sometimes Zoom doesn't work right. Sometimes technology doesn't work right, particularly now when Mercury's in retrograde again. So you're frustrated, but you can even sign up for a free Zoom and go on and practice. You can go on, start a meeting, and talk to yourself, but at least and record it and play it back, and you get to see how you sound, what you look like. Are you smiling? This is great for people who are in transition because they're doing Zoom interviewing. So it's all a comfort level, like anything else.
Yeah, I agree with you 100%. I was thinking as you were speaking of my own particular, with your help, I've been able to expand a lot of the things that I do on LinkedIn, and to be able to communicate with a lot of different people from different backgrounds, obviously different looks and different ages. I always wonder though, because I have my age and I'm that guy now that seems to be on the hot spot, that I'm perceived by the people I'm talking with or out in the LinkedIn space, professional space, as somebody who may be a certain way. How do you, other than one-on-one conversation, I put a lot of videos out and I put things into the marketplace, which I think part of what Zoom does, part of what a lot of these interactive media does, is to be able to allow you to be able to send out a message. How do you make sure that the message you're sending out is what you really want to do? And I think this is what you can really speak to, because this is how you helped me in LinkedIn.
Well, this is, you have to, it's all about communication. It's all about messaging. It's all about understanding who your audience is, understanding how they're going to receive it, and also understanding that if you're speaking to different types of people, the message is going to be perceived in different ways, and you may be sending a different message to different people. I mean, this is a really great question you raised, Jeff. And I'm not sure that there's a clear-cut answer. I think you have to look at what you get back. So if you put a video out there, if you put a message out there, look at what's coming back compared to, and I just had a client who did this, 2 email messages, same subject line, but different, one paragraph, different content, a dramatic difference in the response to the same people, same type of people. So I think you have to, some of it is trial and error. What are we putting out there? How do we make sure that we're saying what we want to say? But number one, if you're being authentic and you're being honest, and you're offering services, if your goal is what you can get versus what you can give, then I don't bother.
Right.
But if you understand that, you're there to listen and to help others, and you learn to tweak your message accordingly, it's kind of a trial and error thing too.
Hey, Debbie, we're up against the clock here. Could you shout out your phone number, a way by people can get a hold of PI Media and you?
Of course. It's PIMEDIA.PImedia.me. I'm Debbie, DEBBIE, at PImedia.me. And you can actually call me 702-720-6560. That's 702-720-6560. I'm happy to answer anyone's questions. I'm happy to give you some feedback on LinkedIn as well.
Debbie, thank you very, very much for coming on the show again. Really appreciate it.
You're very welcome, Jeff. Anytime.
Thank you very much. That's Debbie Harris from PI Media. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in. Thanks very much for listening. We are on 8 of the large and biggest podcasts out there, from Spreaker to iHeartRadio, Google, and Apple. All of these are part of the network of podcasts that are out there in the world. I had a client listen to me the other day from a distant city on one of these podcasts, so I really appreciate them doing that. The show, The Mortgage Voice, we are on YouTube. If you go to YouTube, Jeff Barton, The Mortgage Voice, as well as 5 different radio stations, K-Tahoe up in the Tahoe area, KMET, KCAA in the Inland Empire. We're in K-Ship up in Las Vegas, AM 1400. And our new affiliate is KMIN, is that correct? Down in Albuquerque, New Mexico?
That's correct, K-Mine Country.
Okay, very good. K-Mine Country, and I really appreciate that particular group of people and getting to know them and the professionals who work down in that area. Today, we're really happy and lucky to have Darren Woodworth back, real estate agent up in the Tahoe area, who has been on the show several times, but we needed to check in because I really want to know what's going on up there. Darren, how are you?
Oh, great. Couldn't be better.
Excellent, brother. So tell me a little bit about what the real estate market, are we seeing any kind of lull? Are we seeing any new inventory on the market? What's happening?
So I'm actually up here in North Bay, so
Okay.
right off Vallejo, Napa area.
Right.
And the market is on fire up here.
Yep.
Napa, California is exploding again, low interest rates. Just put 3 deals into contract. So
Congrats.
there's no
Yeah.
slowdown for us.
So when you say that it's on fire, when was the last time you saw it like this?
It's been a couple of years, but it hasn't really slowed down. It slowed down there for a minute.
Right.
With the pandemic. I had 3 deals in contract. The shelter in place hit in Napa, and all 3 of those deals fell apart. The buyer that was buying my seller's property, loan qualified, kind of changed guidelines right in the middle of it, so they didn't qualify. So I couldn't sell their house. I couldn't get them into the house that I was trying to get them into. So that was kind of crazy.
Hey, interesting that you brought that up. You have buyers, sellers. I'm sure you work with both. When you're looking either as a buyer's agent or as a seller's agent, and we get into a situation like we're currently in, how deep do you go into, obviously as a seller's agent, but as a buyer's agent, when you're trying to help them either advise them on what kind of loan, as a seller's agent, do you get into the incredible depths to find out if they really qualify, especially with all the changes in the programs? How do you wend your way through all that?
Well, the deal that I just got done doing was we did a seller carry for $100,000 because the guy didn't qualify for the loan, and that was kind of different.
Right.
My buyer was willing to do a rent back on his house and do a seller carry for the house he was buying. So instead of selling his house like we were going to do, the buyer didn't qualify, so we had to change gears and go to a rental and rent his house. And then to buy the house that he was trying to get into, we had to do a seller carry because he wasn't getting any money from the sale of his house. So the seller on the house they were buying agreed to $100,000 seller carry. And I'll tell you what, that was quite the, it was a lot of work, but it was very gratifying when we finally settled.
There's a lot of moving parts in a deal like that. So you had a couple of issues come up because of COVID, I assume, and that creatively speaking, you were able to work it out by on the buy side for the seller, a carryback, and then obviously renting out his property. It might work out in the long run better for the seller.
Absolutely. So we're in contract right now, so it's getting ready to finalize. So it's been a long haul, but especially for the buyers or the ones that we're selling,
Right.
We got in contract on 3 different properties.
Oh,
and
boy.
3 different properties fell through. On the first one, it was there was something on title. There was 4 people on title, and we only had 1 person signing. So when we got to escrow, there were like, there's 5 people on title. How come there's only 1 signature? And we couldn't figure it out. So,
Yeah.
we actually went to a bank owned, had to foreclose on it.
I see. Well, what happened to the sellers? They just disappeared, or just didn't want to be a part of it?
They didn't know the other 4 people on the title, so they had no clue who was on title. So somehow they got scammed.
Oh, that doesn't sound right. I mean,
No.
anyway, that, in a situation like that. Now, that's it. That's another interesting point. We're going to enter into a situation next January, which is only 6 months away, where the forbearance period is going to be up on a lot of people who stop paying their mortgages. What do you think are the chances that we're going to see a flood of properties on the market in the foreclosure area because the forbearance people can't pay their mortgages anymore?
Yeah, so I've come across 4 properties that I was going to list, and they got letters from their lenders saying that you don't have to make a payment for 6 months. So instead of me listing those properties,
Yep.
The properties they're not listing. They don't have to make a payment. So I advise them that it's kind of you don't know whether to do it or not because
Right.
6 months down the road, are they going to ask for 6 months worth of mortgages? So
Yeah, and the other thing is, if they don't pay, or there's no real reason, they can't get a refi. I mean, unless you pay 3 months in a row and show that you can pay and you have the ability to repay. So what's going to happen in 6 months? They're going to be forced to sell it on the foreclosure market and wreck their credit. I don't know. I just don't think that's right. The lender to tell them that. Or the servicer, whoever told them that.
Yeah.
That just doesn't make any sense at all. Prognostications for the rest of the summer. You think we're going to see any more inventory? I know it's really low inventory in a lot of places. What's it like up there?
So Napa, every property that comes up on the market is sold within a week. 700, 800,000.
Wow.
The listing that I just got into contract on Sunday was the only 3-bedroom, 2-bath home in Napa under 550, and it listed, and it's in contract for 525 right now. So, it's a hot market up there.
Yeah, it's a tremendous market, and obviously, if you're a listing agent right now, you're doing very well because, as you say, the properties sell as soon as they come on the market.
Yeah, so Vallejo, which is 9 miles away from Napa, that's the last affordable city on a bay. So you could actually get on the ferry here, and it'll take you 45 minutes to get to San Francisco on the ferry. And homes in this neighborhood around here, 400, 375, 400. So that's the last affordable city around. I'm not sure how long that's going to last.
Yeah, especially since you're broadcasting it on the radio. But hey, speaking of that, shout out your phone number in case somebody wants to get in on a property that is, as you say, affordable up in the Bay Area.
Absolutely. It's 408-425-7845.
We're talking to Darren Woodworth. He's a real estate agent for Bridgeport Real Estate and been experienced up in this area for a long time. Have you seen it like this before? Do you think we're going to see these low interest rates like this ever again? I mean, at 2.5% on an FHA or a 15-year and under 3% for 30-year fixed. It's pretty amazing.
Yeah, it is amazing. That's what's kept the market on fire. So
Right.
through the pandemic, even though people couldn't go show houses, a house would come up on the market, virtual tour it, and it would be sold within a week. So with no
Right.
one really looking at it, I mean, it was virtual. So we're still doing the virtual tours right now, but you could actually
Right.
go inside the house now. You just have to wipe everything down. 3%, 30-year fixed is amazing.
It's really amazing. Hey, Darren, we've come to the end of it. Thanks very much for giving us an update of what's happening up in your area. I really appreciate it.
Absolutely. Thank you, Jeff.
Okay, thank you very much. That's Darren Woodworth from Bridgeport Real Estate. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for listening to the show. Thanks for tuning in each and every week. We're on a number of different radio stations in a bunch of different states. If you want to see the show, you can go to YouTube. YouTube channel is Jeff Barton, the Mortgage Voice. And we're on 8 different podcasts. We are loving the podcast. People can get to us from anywhere, whether it's Google or iHeart or Apple or Spreaker or any number of the other terrific podcasts that are out there. There's a lot of competing space on a lot of social media for voices, for people to give information. On this particular show, we try to give information about mortgages, information about real estate that can help you during this time, during any time. This is not a commercial. This is information-based, and I really appreciate you listening again. With me today, again, is Charles Giscombe. He is the Qualified Employee Manager of the Las Vegas office of Malibu Funding, and he joins us now to clue us in on what's happening not only there, but around the country where he does a number of loans. Charles, how are you?
Great, Jeff. How you doing today? Thanks for having me.
No, thank you for coming on. I know it's been a while. You know what, the problem with this pandemic that I find is that I a lot of times get lost in the cave, meaning that I get focused on something, and because I'm not around people in an office situation, I tend to lose focus and, you know, as I say, get a little bit of tunnel vision. How is it in your end of the world when it comes to dealing with clients and dealing with lenders? Is it the same? Is it different? Let me know.
Well, I'll be honest with you, Jeff. It's a lot different, but in a number of cases, obviously, in dealing with traditional loans, it's kind of the same.
Yeah.
Obviously, everybody has changed their focus in regards to protecting themselves because everybody's a little uneasy at what's going on.
Yeah.
Even from a traditional standpoint, people are, very cautious and conservative. And so, I've been trying to be the same old truck I have been, Jeff, and just basically walking them through the situation, trying to place them where they need to, and just trying to facilitate their needs, just trying to service their needs as we always do at Malibu Funding, Jeff. A lot of times people are very confused and very scared because a lot of them feel like they're not going to be able to qualify for a loan anymore, Jeff.
Right,
Because
I know. Yep.
So you just try to put them at ease and let them know this is just a phase like this very many that we've been through and that we will make it through. But banks are still lending. And I always tell them, Jeff, if you are documentation friendly and you keep your information organized and in place, there's still loans out there for you. It's just a matter of finding the right individuals that can place them with the right programs and guidelines. And at Malibu Funding, Jeff, you have afforded us the opportunity to offer a number of different products to all our different clients.
Interesting. The products themselves, the programs, we get on the phone each and every week wondering when we're going to have a certain program back or be able to service a certain type of borrower. What are you seeing is opening up, maybe what hasn't come back. What do you think? What do you see out there?
Well, honestly, the traditional loans, Fannie Mae, FHA, VA, they're still there. They're still getting done. In some cases, they might raise the credit score requirement just a tad bit, or
Right.
raise employment verification a little bit, but they're still transacting normally as they were. The loans that went away, the loans that disappeared the most, I should say, Jeff, were a lot of the non-QM loans that were based on the stated, that we always talk about, stated loans and different commercial loans and bank statement loans. A lot of those loans, those companies went away because obviously the secondary market is very scary for them. And the reason why is because they're not based upon too much documentation. They're based upon the property's values and to do with the individual's credit score. And so they were basically given higher LTV loans based on less information. And obviously, in this climate, if you can't be sure what the values are going to be, and you're not sure about people's situations that way, those loans are going to go away because they require the least amount of documentation, and people are having less than the least amount of documentation now because of this situation, because now they're losing jobs, there's different things. And so the uncertainty of the secondary market and them being able to move these loans and to sell these loans had caused them to kind of back off and not put their warehouse lines in harm's way. And because of that, they backed off. And a lot of them stayed in the game, but what they did do was they lowered the LTVs, which would require individuals to come in with a lot more money. And necessarily were used to coming in with 10%, and now they're asking this individual to come in with 30 or 40% to get the same transaction done. And for a lot of people, they weren't cash heavy that way, and so it wouldn't allow them to get that loan done. What I am seeing now is that slowly but surely, these programs are coming back and the LTVs are rising, and they're providing individuals, becoming more confident and having more opportunities and options for them to get loans done, which is a great thing because now these loans help a lot of people that aren't traditional loan friendly, and so the fact that these LTVs are coming back, loan to values, it's helpful. It's good. It's good to see because I have a lot. We're always getting phone calls, but now people are saying, "Okay, Charles, it's coming back. It's coming back. It was 60%. Now it's 75%. It's going up to 80% now. Some places are doing that. Some places are coming back to 85% LTV, which these people are happy and ready to transact again."
Yeah, couple things. In what we experience now, and always have in the lending world, is a thing called overlays. Overlays are based on the lender, not necessarily the investor, and the lender has fears of a certain either group or situation or whatever it is, and basically it costs people more money. Are you seeing overlays disappear, continue? Where are you seeing that? Because it costs, obviously, the consumer more money with more overlays.
So with the overlays, yes, that is another barrier or another situation put in play to kind of load the deck for the investor, to give you more comfort, I should say, a warm and fuzzy, to get a loan done. Those overlays, may increase the credit. And what they'll do is, if you have less than perfect credit, they can charge you more. Documentation, employment verification, different things, cash out refinances, different things overlays are added to. And this basically is costing individuals money in order for them to get these type of loans if they are not of perfect credit. What I have seen is a lot of the credit score requirements in those overlays have been lowered or going away. But I do still see, they're not quite sure that the market is back to normal, which is not yet. It's going there. We have our good days and our bad days. But with these overlays, Jeff, I am seeing some lenders come off of these overlays and trying to transact a lot more normally than they were before. But yes, I am still seeing overlays in the market.
Okay, very good. And it affects certain groups more than it affects other groups. Obviously, those people who have W-2 jobs, 700 plus FICO score, and has had a job for 20 years, they're not the people that are going to be affected by this. It's people who are self-employed. It's people who aren't necessarily, they're credit challenged, that they may have had a credit event, a health issue. Borrowers like this are the ones that are going to be affected. And they, as I said, they affect geographic areas a lot. They affect certain groups a lot. I'm just glad to hear you say that they're going away a little bit, or even more so that they're going away a lot, because loans are expensive already for a lot of people. And those who are marginalized by whatever event is going on today or in their life, they're affected by it. And obviously, more people that we can give loans to is better for everybody.
Absolutely, Jeff. And with those overlays, what people don't understand is that normally you may have a traditional loan, which will have a lower interest rate. But in order to do a particular loan, obviously you have to go to a certain lender, which will have overlays, which will cost you more. Let's
Right.
just take an example. A normal person, like Jeff said, with a W-2, 700 credit score, money in the bank, employment continuing, and there has been no break, that same person will get a different interest rate than an individual who is self-employed, is only going to provide bank statements, is doing more of a stated type of loan. That interest rate is going to be higher. And so what's going to happen is that there's going to be added costs, added adjustments, hence overlays, as Jeff had said, I always like to earn while we learn when we're talking to potential clients or customers on the phone, and that is those are added to the interest rate, which in turn turns out to be money that is the cost to the borrower.
Hey, Charles, can you shout out your phone number? We're up against the clock. I'm sorry. I would love to continue the conversation. We'll have you back soon. But tell people how they can get a hold of you, if you would, please.
You can get a hold of me at 702-328-5191, 702-328-5191, or you can email me at charles@malibufunding.biz. That's charles@malibufunding.biz.
Charles, thank you very much once again for coming on the show. You always are a great guest, and I appreciate you coming on again.
Jeff, I love having it. I love helping, teaching. Like I said, earning while we're learning is important for us, and I thank you for having me.
Thank you very much. That's Charles Giscombe from Malibu Funding. I'm Jeff Barton, your voice for the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Hi, I'm Jeff Barton. You are listening to The Mortgage Voice, and thanks very much for tuning in today. I know you're rolling around in your car right now, Saturday and Sunday afternoon, looking for something to do, maybe going to Home Depot if you can get in, wear a mask, of course, we all do that. And you know what, I'm sorry I did that. I get quite angry at many people, especially people close to me, who continually say, wash your hands, wear a mask. Yes, we do that. And one of the things that we've all noticed in the economy, even in those states that have opened, the restaurants that are open, businesses are open, stores that are open, we're still seeing less than 50% of normal foot traffic. Why? Because many, many people are afraid, and they're afraid of the coronavirus. In the company I work for, we had a gentleman who lives in Las Vegas who contracted coronavirus and was on a respirator for almost a month. He's fine now. He's out of it. Spoke to him yesterday. He told me he's extremely scared, obviously, right? Because they don't know if, in fact, you have had the virus, if you're going to or can contract the virus again. So the economy bouncing back is not necessarily assured until we get a vaccine. When do we get that vaccine? Dr. Fauci says probably January, February, March, in that area, which is right. It's about a year from when we started the whole thing. And it's just about the time that the foreclosures are going to start to happen. So what does this mean going forward? I don't know. But I do know that the timing is right for the vaccine at that end of the spectrum, a year out. And obviously, we're looking to reemploy many millions of people so that we don't have a repeat of this mortgage meltdown situation where we just found many markets upside down. A couple things I wanted to get to. I got to the home prices. We talked a little bit about the mortgage rates being steady in the previous section. The CFPB has rolled out some new rules, and some of the new rules have to do with the debt to income ratios that we currently use to underwrite files. One of the things that we talk about when we talk about 30-year fixed rate mortgages is the fact that there's a thing called the mortgage patch. Now, I know it sounds like some patch you'd put on a bicycle tire, and in a little bit it is. The mortgage patch, for all you don't know, when you're getting a fixed rate 30-year mortgage or some other mortgages, the debt to income ratio is supposed to be no more than 43%. All bills in, not just your mortgage, which is a different ratio, but your debt to income ratio is all your bills plus your mortgage, and that ratio is not to exceed 43%. And that was a law passed by Dodd-Frank back in 2008. So because many mortgages, which are purchased by Freddie Mac and Fannie Mae, if you have a 30-year mortgage right now, and you are a standard W-2 borrower, 20% down type person with a 700 FICO score, 100% your loan, if it's within the conforming limits, of course, is going to be sold by whoever did your loan to the great government entities, the GSEs, Freddie Mac or Fannie Mae. And so why does that happen? Of course, it happens because we need to liquefy or get money back into the system to lend it out to the next person. And that's the only way it works, is by taking a loan, borrowing money, lending it to the consumer, taking that note and selling it back to Fannie Mae and Freddie Mac, then thus getting that money and putting it into the system so that we can lend it out to somebody else. But this 43% DTI really eliminated millions of very qualified borrowers, except for the fact that they couldn't get under the DTI issue. So what happened is this mortgage patch was really a granted acceptance, or not acceptance, but granted exception. The exception is that you could go, in some cases, up to 50% debt to income ratio or higher, depending on the loan, the program, and everything else. So this patch, this 6 or 7% difference in the DTI ratio meant that millions of people could get a home. People who had 750, 800 FICO score, made great money, had been in their job forever, W-2 employees, all the things that would make a borrower a great borrower. But because Freddie Mac and Fannie Mae will now buy these loans because of this patch, that simply means that they get the best rates out there, which is what everybody wants. They want the lowest rate and they want the most money. And so to be able to do that and offer that to clients, it's been a great thing. So what happens when the patch runs out? And it runs out in January 2021. So there's been talk about how do we fix this? How do we do it? So the CFPB came out with some rules and regulations, new rules and regulations, and we're in the public comment section period right now, is to do away with the debt to income ratios entirely and go to a different way to look at risk, assess risk, and assess risk according to your income based on the market that's going to buy that loan. Now, the confusion here is that particular aspect of underwriting a file has yet to be really rolled out and fleshed out. So the consumer is going to have some difficulty understanding why their loan will have this particular rate and what happens if the rates go up, what happens if the criteria changes in this new way to look at files. We in the business, we're not quite sure either. There are several different changes and proposals in order to fix this problem. As lenders, as people in the brokerage business, we want more borrowers, not less. We want good borrowers who aren't necessarily a risk to be purchased by Fannie Mae and Freddie Mac. Why? Because those loans purchased by Freddie and Fannie, hey, they're guaranteed. So the lender is really off the hook. So the more of those loans that are available out there for us as lenders to be able to lend to the consumer, the better it is for the marketplace, because it's backed by Freddie Mae, backed by Freddie Mac, and unless there's fraud on the file, you're not on the hook after 3 years. And that's really why we're looking for a good, solid fix in this particular area. We talked a little bit about forbearance. In the forbearance area, in another aspect of what's happening in lending, there's a thing called overlays. If in fact all the information you've heard about forbearances and sort of the doom and gloom that I've been talking about a little bit, projection in the future, if this is happening, how does a lender protect themselves? How do they make sure that they don't have to buy those loans back if there is a default or if the borrower stops paying? One of the ways to mitigate or really insure against that is to increase the fees, increase the rate. Now, is this fair to the borrower if they're not going to foreclose or get forbearance? No, not really. But in order to do this across the board, in order to protect a lender who's really on the hook for a lot of this stuff, as is the servicer, as is the end investor, as is ultimately the taxpayer if it defaults and it's with Freddie Mac and Fannie Mae. One of the issues here with the overlays is that it's arbitrary and capricious. Don't you love those words, arbitrary and capricious? When you hear that come out of any politician's mouth, and maybe you've heard it, and that's where I got it, you go, what does that actually mean? Well, in this particular case, arbitrary and capricious means that it is an extra quarter point, eighth point, 3/4 of a point tacked onto the loan by the broker or by the mortgage banker, not by the end buyer, Freddie Mac or Fannie Mae. So how do we mitigate risk for the person who's originating the file while we're still trying to open up to the most borrowers possible at the cheapest price? That's the key here in trying to keep lending fair and balanced, because with this particular overlay, the danger is that ethnic groups and racial groups are stigmatized by what they call redlining, which draws a line around an area and says that's an issue for an area because they're in a higher rate of forbearance or foreclosure, and we're going to charge them more money. That's illegal. Anyway, I'm Jeff Barton. I'm your voice in the mortgage industry. Really appreciate you listening to the show today. We'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.